Borrowing costs have risen. Why? Because of tight liquidity conditions. In fact, on September 19th, liquidity in the Indian banking system had reportedly declined to its lowest level in close to 6 months. According to the report, this happened because corporate advance tax outflows and the Reserve Bank of India's actions to stabilize the rupee have eroded the funds in the hands of lenders. Between September 16th and 19th, at almost 70,000 crore rupees, the central bank had infused the highest amount into the banking system since March 24th. This was another indication of the tight liquidity conditions. Also, in August, the RBI or the Reserve Bank of India had mandated that banks maintain an additional 10% cash reserve ratio for an increase in deposits between 19th May and 28th of July. This led to the withdrawal of over 1 trillion rupees from the banking system. Even though the situation may have improved now, let's delve into what is tightening liquidity, also known as liquidity deficit, means. In the banking system, liquidity is a term that refers to readily available cash that lenders require to meet their short-term financial and business needs. When the credit demand coming from borrowers start outpacing the funds that are available with banks, we say that banking system liquidity is in deficit. Also, liquidity is considered to be in deficit when the banking system is a net borrower from the central bank under the liquidity adjustment facility. And what factors can be responsible for liquidity deficit? These can range from advance tax payments by corporates and a jump in bank credit to incremental deposit growth not keeping pace with credit demand. The other causes can be an increase in GST outflows and cash withdrawals during the festival season. RBI's intervention to stem the rupee's fall against the US dollar can also be a factor. Banking system liquidity. If the banking system is a net borrower from the RBI under the Liquidity Adjustment Facility or LAF, we say that the banking system liquidity is in deficit. The reversal would make it a surplus. What is the impact of tightening liquidity? Tight liquidity conditions can lead to rise in yields of government securities, and this could also lead to rise in interest rates for consumers too. To manage this situation, the RBI can increase the repo rate, which would mean a higher cost of funds. Higher repo rate would mean higher lending rates by banks and therefore higher interest rates for consumers. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.